Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. And if you're like many Canadians, you may have spent years following an investment plan to build your nest egg. But in many ways, the planning work really begins once you reach retirement. That's because crafting a retirement income plan can be one of the trickiest tasks in personal finance. There's so many variables to consider, it can be tough to keep them all straight or even know where to begin. But don't sweat it. We've got you covered in today's session. A veteran DIY investor and early retiree will share his step-by-step guide to retirement planning. Plus, he'll tell us 5 things you can consider to help safeguard your retirement income. Make sure to stick around to the end of our conversation as well, and we'll get a take on some of the popular retirement planning tactics he has. But before we dive into our conversation, I quickly want to highlight some features of our broadcasting platform to help you get the most out of your viewing experience. So as you can see on the screen, we are going to, if we look at the very top left, you can see on there, there's some great resources and information available. There's the Government of Canada Retirement Income Calculator. There's a number of webinars, and there are some links to the My Own Advisor blog and website for our guest today. If you scroll over to a little bit to the right on the bottom, that's where you're going to be able to see upcoming live events, other webinars that we do have upcoming. So I definitely encourage you to check out that and register for those today. If we scroll over a little bit further to the right, probably one of the most important ones, because we will want to hear your questions later on, is the Q&A section. So the question and answer, this is a live event. So we're going to have, our guest is going to be able to answer some questions after our conversation in the earlier half, and we want to hear your questions. So make sure you do check out that, and you can see that Q&A section there. But other than that, there is a few other items on the left. You can actually open a TD Direct Investing account, and there are some links there as well to our YouTube pages and our socials that you can also, we would love to see you subscribe and check out some of the content there. All right. So with that said, let's get into our conversation. Joining us is Mark Seed. He's the founder of the popular investing blog, My Own Advisor. And he writes about his journey to financial independence and the lessons he's learned as a DIY investor. He also offers low-cost financial planning services through his website, Cash Flows and Portfolios. Mark, it's always wonderful to have you here with us. Thanks for taking the time.
Happy to be here. It's great to be back, and love doing these live events. It's always great to see what the readership or the viewership has in store for me. So looking forward to teeing that up.
Yeah, and I know you and I have sat down before, Mark, and we've had discussions, but one of the things I'm dying to know today is you're on track to achieve financial independence as of next year. So congratulations on that. And how are you feeling now that the dream is finally a reality?
Yeah, I thank you, first of all. You know, it feels good. You know, I've been at this DIY investing journey for, you know, the better part of my life. And like most Canadians, probably, you know, finding means to squirrel away some of their money, trying to think about the right accounts to put said money in, think about what investments to put that money in to watch it grow and compound away. So first of all, it feels great. But I would be remiss to not include the fact that it's not without some trepidation, just because the you know, the financial future is always a bit cloudy and there's always a bit unknown. And we'll talk about it, I'm sure, about, you know, my plans for potentially some semi-retirement work and the like. But yeah, it feels good, and just looking forward to obviously all the next steps that the future can provide.
Yeah, you're doing a great job on sharing that journey. And interestingly, you still intend to work at least part-time, even though you don't necessarily need to. You know, that might sound a little funny to some people, you know, wishing they could retire today, me included. I'm a little bit jealous. But why do you continue to, or plan to continue working part-time?
Yeah, it's a great question. And I actually get this quite a bit in the website and my readership. I would say first and foremost, I have the energy still to work. I enjoy what I do at my current employer. I love the mission and the value proposition that my current employer provides. So hopefully there's a transition there, and hopefully not too many folks are taking time off work to watch this as well, but I know some of my employer colleagues follow my site. I would say it's also for me, semi-retirement appeals to me, or financial independence, kind of work on own terms, because it's a great way to keep my mind, stimulated and active. And to be honest, I'm still fairly young, right? Just into my early 50s right now. And so because I have the energy, because I want to keep my brain kind of stimulated, I just want to keep going. And honestly, the semi-retirement world, I think, is a perfect way to transition versus kind of go cold turkey, if you will. So this really appeals to me. It may appeal to other people, but Brian, if you want to do on full-on retirement in golf, more power to you. So.
I knew you were going to bring up golf, and I know your part-time job might be at the golf course, right?
It could be. I've got some close friends in the city, and yeah, we'll see. Maybe a day a week or something like that. I may be at a pro shop near you. Who knows? So.
Yeah, absolutely. Well, that sounds great. So that being said, so what's top of mind for you as you prepare to enter into semi-retirement next year?
Yeah, well, I mean, beyond lowering the golf handicap, that would be good. But I mean, honestly, I think it's really a life-work balance, right? Or not so much a work-life balance. So for me, it's a little bit more on focus on self and wellness, a little bit more exercise. And I've been doing pretty well at that in 2024, but really want to ramp that up more in 2025 if I could. Maybe look into volunteerism, a little bit, and especially in my community. I think I have some skills and hopefully a little bit of time to give back. Probably a little bit more travel, and last but certainly not least, time with the family, right? Nieces and nephews are getting older. Spend time with them, doing things outdoors and then maybe spending more time with immediate family, like sister and their kids, and my parents as well. So yeah, it's a blend of everything, and that's kind of what's top of mind, to be honest. Is that it's more of a life work balance and not the other way around.
Yeah, that's great. I think a lot of us forget about the non-monetary things like family and your health and things like that. So that's awesome.
Absolutely.
All right. So we have a little fun thing that I want to do with you, Mark. We're going to do a lightning round to get to know you a little better. So how this works, I'm going to ask you some questions. You got to answer them as quickly as possible. So the super quick answer. We'll just do a few questions to kind of get know you a little bit better, and yeah, we'll do it really quick before we get into our main questions that I want to ask. Are you good? Are you ready?
Yeah, fire away. Yep.
Okay. So how will you celebrate the official start of your early retirement?
Lightning round. A really nice dinner out, I think. Yeah.
All right, sounds good. All right, and then what's the first vacation you'll take once you're officially retired?
Officially retired. We got plans to go out west, maybe Victoria, go to BC again for a couple of weeks. Tofino's been on our mind, so yeah, let's go with that for now, Brian.
Amazing. I feel like these are like streeter interviews. I'm putting you on the spot here a little bit.
Yeah, absolutely. keep it coming though. It's
fun.
Think
fast. Yeah, awesome. So what's one thing you wish you did differently as you worked towards early retirement?
I can't think of too much, but it's okay to take a bit better blend of saving for retirement and maybe spending a little bit on the way. But I think I've pretty much done a pretty good balance. But that would be my caution for anybody is just try to find your balance. Try to find your balance.
Oh yeah, you mentioned earlier like that work-life balance. Yeah, for sure.
Yeah, totally. Excellent. Exactly that.
All right. So what do you feel will be your biggest financial challenge in early retirement?
Spending the portfolio and drawing down the portfolio that we're talking about. I think we've done well, but at the end of the day, the money is saved to be enjoyed, and I think we have a pretty good plan. But just freeing up the purse strings or the wallet, if you will, a little bit more and more. So that would be good.
Yeah, having to spend. Oh, I know what you mean. That's hard.
Exactly.
And most importantly, so how many strokes do you need to shave off your golf game to consider it a successful early retirement?
Oh my! I've got Ben Hogan on the wall for inspiration behind me, but I'll never get to that level. Let's say if I can get down to a 5 handicap where my game travels really well, like I could pretty much play any course in around there. I think that's pretty darn good.
Oh, that's amazing. Yeah, sounds like golf can be frustration in retirement as well, right?
It can be, but
Absolutely.
again, better day on the golf course is better than doing other things sometimes. So yeah, looking forward to it.
That's true. Yes, they always keeps you coming back. Well, thanks so much, Mark. That was great stuff. Thanks for playing along. So now let's get down to the heart of our conversation: the key steps to building a retirement income plan. So my first question deals with so many Canadians put off retirement planning until they're close to retiring. So why do you feel a finely tuned retirement income plan is so important rather than simply, letting the chips fall where they may?
Yeah. So you know, a little joke here, but like living on a prayer worked well for Bon Jovi, but I don't think it works well for anybody else, to be honest. We're not that talented. So I like to think in that. Again, in my day job, I do planning work, I do project management work, and it's probably very aligned with some of my analytical skills and background in terms of planning, but also going through the process of planning. And so instead of just throwing up the deck of cards or letting the chips fall where they may, I think some level of planning and forecasting is helpful because A, I think you can learn a little bit about yourself, about where you're going, and B, you can also make some course corrections on the way. So no income plan has to be perfect. We can't predict the future. I've mentioned this before, either today and previous webinars, that the financial future is always very cloudy, but ultimately having some sort of plan, something that you can measure yourself against, good, bad, or indifferent, just allows you to make a few course corrections and updates along the way. So I think it's important to at least have something in place, which is better than absolutely nothing at all. And yeah, I think it's always said, at least in my space, the difference between hope and reality is usually disappointment, right? So you want to close that gap a little bit.
Oh, that's great. And I know, like, coming along that journey, there's so many things when you get there at the end that if you didn't know about as you're coming to that planning stage, it can really impact things like we've talked about it before, like taxes and other things and what you're going to put that money into. So I know we're going to get into that a little bit later, but it's something you don't realize until you actually sit down and think about it for sure.
Absolutely. And I think that's just the whole, um, not to say that financial plans have to be, uh, codified or anything, but it's just thinking through some of the elements of inflation, taxation, spending rates, where the money potentially would come from. It's just getting into the habit of thinking and trending some of those things. That's all. And those are great wins for most Canadians, just to be going through those concepts.
Yeah, so this is going to be a great conversation because I know I'm one of those people, like we said, just let it be, whatever it may be. I do that when I go on vacation. I like to just like go on the vacation and let it be, see what happens, happens. I don't think that's a good strategy with with retirement for sure. So what would you say are the key steps to creating a retirement income plan?
Yeah, so I actually I've distilled it down to two, or like 2B, to be honest. And I actually have a post on my site about your free playbook, if you will. But I think ultimately it all starts with your spending goals. Um, so ultimately, what do you intend to spend, and when do you intend to spend it? And then from there, what you can do is try to think about reverse engineering, if you will, right? Thinking and working yourself backwards in terms of where some of those um, spending desires, wants, or needs are coming from. So is it coming from CPP, Canada Pension Plan? Is it coming from old age security? And if so, when? Is it coming from a workplace pension if you're lucky enough to have one? If not, you have other accounts at your disposal, as you know, registered retirement savings plans, tax-free savings accounts. So I think, step one is really looking at your spending goals. Step two is looking at your savings and income sources. And then 2B, or step three, is ultimately looking at your minimum lifestyle. So you may have high aspirations to do your travel, put your feet up on the beach, Brian, and what have you, and that's great. But what is the bare minimum lifestyle you can spend? And ultimately having a range between your minimum lifestyle and maybe a desired is what you want to be able to accomplish. So those are some key components that I would start with. And I've put that on my website, and it's a big part of where I think about.
Okay, great. Well, let's focus on that first goal. You said the spending goals. Some Canadians might not know what their spending goals are and how much they would need to support them. What are some of the key questions they can ask to help figure that out?
Yeah, I mean, I think the list could be fairly long, right? Depending on the individual or the couple. But, some of the things that I, ask myself in terms of spending goals is, what might you spend annually? Like, what is your baseline in terms of spend? Some couples or individuals may want to spend on average 5,000 a month or 6,000 a month. Some may be much higher, depending on their aspirations, and that's okay. But really figuring out some of your base spending or your annual spending would be good. Coupled with that is, like me, I plan to enter some form of semi-retirement in 2025. And so is there part-time work that could be coming in? Is there hobby work? There could be passion projects that you want to pursue? Maybe think about spending that could be variable, right? I don't know about you, Brian, but I know any given month, or certainly over the year, our spending kind of goes like this, right? Nothing's like a straight line.
For sure.
And so do you have higher spending in some years versus other years, right? You buying a car or not every few years or every 10 or 15 years. Inflation, we've talked about that quite a bit. We can talk more later about some tactics to kind of inflation protect your income plan. Capital expenses, I've mentioned the car, but maybe you need to put a roof on the house. Maybe there's some gifting involved to family. And then thinking about estate and other types of factors as well, is how much do you actually want to leave and bequeath to family, friends, philanthropy, and otherwise. So I would say there's a lot of spending decisions that need to be thought out, and you don't need to solve all these today, right? I think about these things and I write about these things, but I haven't had these things certainly codified for time immemorial. But I do think about them from time to time, and it helps me with this plan and things we talk about today.
Yeah, so it can be very subjective. Would you agree with that too, Mark? Like, it's just the really key thing is sitting down and thinking, hey, what do you picture in your retirement? But like, making sure you write that down and tabulate what are your spending needs going to be.
Yeah, absolutely, and it's different. I mean, based on some of the work I do with cash flows and portfolios, some of the free replies, and where time permits, I answer emails, and I try to reply to every comment on the site. I've noticed over the many years of running this, the sites and such, it's different. It's very individual. No two plans are the same. No two spending patterns are the same, and that's okay. But it ultimately means that, just like a DIY investor, you can be a DIY, asset decumulator as well, right? So your withdrawal plan may be a little bit unique to yourself, and that's something that you have to work through as well. So hopefully these prompts or these questions to the viewership today kind of help them out and trigger some thinking for their own kind of self-inquiry, if you will.
Oh, that's excellent. Well, that brings us to the next question I have for you is if we need to spend, if we're going to be able to spend, we have to have income. So that brings us to the first key decision you feel retirees can make to safeguard the retirement plan, and that's to set conservative assumptions for investment returns and inflation. Why do you feel that's so important?
Yeah, I think it's important because I would rather, save and have my money working for me a little bit like a pessimist, if you will, but be super optimistic about the financial future, right? So let's take 2024 as a really good example. I don't know if you had this on your bingo card, but I did not see the Canadian stock market going up 20% this year. That's basically what it has gone up, give or take. We've seen the S&P 500 in the US gone up, 25 to 30% year to date. I mean, these are big investing years, and it happens. It happens every, once every 5 to 10 years, if you will. But this is also on the heels of a big 2023. And so, obviously we're all surprised for the most part, I think, about how well things are gone. And so I'd rather be a little bit less conservative than shooting for the moon, 10, 20% or those types of things. I'd rather be a little bit more conservative. I think FP, Financial Planning Standards of Canada, and the council and all the smart folk that work with the council, they put out guidelines every year in terms of estimated rates of returns. And, by and large, they're looking at about 6%, right, for Canadian and foreign equities and so on. So I personally like conservative numbers, and I would be rather surprised by the big numbers. And so I think being a little bit conservative helps you kind of, again, close that gap, like I mentioned earlier, between hope and reality, and you're not overly disappointed in any one, aspiration retirement plan.
All right. Yeah, you can apply that concept that, what is it, under promise and overachieve? You can do that for your investing.
Absolutely, Brian. Yeah, absolutely.
All right. So here's a hot button question that I want to ask, just a quick one, if you can give your opinion on this, Mark. Should Canadians generally be entirely debt free before retiring?
Wow, that's a good one. Bit of a I don't know, loaded question or other or what have you, because I don't know if you're aware, but we recently got rid of all the debt in our house. We paid off the mortgage actually very early this year in 2024. So that's been a huge financial freedom kind of moment for us. But I would say debt as long as it's manageable, right? And I think you know that can operate on a spectrum, right? So I've seen folks in retirement who write me and provide me my own guidance and saying, hey, I have debt entering retirement, but it's manageable. I can afford my small line of credit. I can afford my car payments because I wanted a newer ride, so on and so forth, and that's great. I would say, though, generally speaking, and I'm speaking from my personal experience, obviously, but being debt free is pretty liberating in that I don't have to pay anybody else first, and basically all the income that is coming in for my wife and I, or what eventually will come from our portfolio, I don't have to use some of that money to service and provide it to somebody else. So hard to really make hard and fast rules of thumb. As always, the favorite answer in personal finance is it depends. But I would say, generally speaking, some of the happiest retirees or semi-retirees I know, they tend to be have very low debt or no debt at all, to be honest.
Okay. Yeah. So it sounds like as long as it's manageable. No, thanks for that answer. I really like that. That brings us to our second key decision to safeguard a retirement plan, Mark, and that's to consider a variable withdrawal approach to retirement spending. So what is it that, or what is that, and how can it help you avoid running out of money?
Yeah, so I'll start off by saying, and we mentioned this, I think, on maybe one of the last webinars, Brian, that we can do a quick Google search and we'll find things like the 4% withdrawal rule that's floating around. So that safe withdrawal rate is essentially based on a study by a financial planner out of the States. It was done, a good 30 years ago. It was in a mix of 50% stocks and 50% bonds. And what the planner basically did is he said, hey, how long could my money last? And what he found is that the safe withdrawal rate is give or take about 4%. So you withdraw 4% of your portfolio every year, increasing by inflation, and that 50 stock, 50 bond portfolio would last about 30 years. You wouldn't run out of money. So that's a helpful heuristic or rule of thumb. But the reality is, if you use a safe withdrawal rate, one or two things could happen. One is you could significantly underspend for your retirement portfolio and leave potentially a lot of money on the table, per se. Or the other flip side, what could happen is that you really just kind of limit yourself in terms of how you spend that money. So some people may, and we'll talk about this later, they may just want to focus on living off dividend income or what have you. And so what they end up leaving is potentially a fairly large estate. So not only do you not spend the money while you're alive, potentially, and the money that you've enjoyed, but now you also create a potential tax or wealth issue when you're older. Now, some folks may want to do that, right? They may have plans to leave a fairly large estate, gift money, create generational wealth. But I would say for most people, they're in the minority, because the money you save in your 40s and 50s is generally the money that you want to enjoy, however which you way to do that. So that type of money is normally meant to be spent and enjoyed, whether it's on family, travel, new golf clubs, whatever it may be. So safe withdrawal rate is fine. Constant percentage withdrawal rate is where you basically just do a fixed amount all the time. And again, that can vary quite significantly, but that's probably not the best formula either, just because it creates a fair bit of rigidity. And life isn't a straight line, like we've said. Some years you want to spend more, some years you want to spend maybe a bit less based on market conditions. I kind of like the dynamic rate myself. I like being variable. I like being flexible. And take, for example, this year, Brian, where markets are way up. Maybe you can spend a little bit more. You can go on an extra week for the vacation in retirement. Maybe you can have the nice semi-retirement or dinner out at a fine dining restaurant that you've been looking forward to for years. And so the aim would be to spend a little bit more in good years, but have the ability to ratchet down or keep your baseline spending in the years where things aren't so great market-wise. So I personally prefer a variable rate, and a lot of the retirees that I know, the semi-retirees that chime into my website, and we have great banter, whether it's on my own advisor or cash flows, a lot of them use a dynamic model, and they think and they believe and they know it works quite well. So long answer to some short questions, but I think it's really important to avoid, safe retirement rules of thumb, but also try to avoid constant withdrawals, because neither of them work in real life scenarios.
Oh, that's a great point. And I like that idea of flexibility. Oftentimes you're sort of stuck as self-directed investors with certain softwares. You might have something a little bit more complex, but there is really great software even from the government of Canada. We have it linked in our resources on the left. So what I like to even do sometimes too, if I'm working or doing a class, is, even if you leave yourself a little bit of room, where if your goal is $80,000 a year and you figure out that I can get about 90, depending on when you're taking all kinds of different variables, but then it gives you that little bit of flexibility to adjust in a particular year. Do you think that makes sense, Mark?
Absolutely, yeah. And there's some great tools out there. I have a few other resources beyond the Government Canada on my website. That's under my helpful sites link. But yeah, I would agree, Brian. Take advantage of the free tools and spreadsheets and other kind of tactics out there, and then tinker with that a bit, because I think you'll find dynamic probably works the best versus some of these other kind of more linear withdrawal methods.
Oh, perfect. I want to go back just a few moments ago, Mark, when you were talking about being conservative. We had a question come in from a viewer, so this was very timely. It was one that I was just asking about your conservative approach. So we had a question from Luciana saying, for conservative, do you mean invest in bonds, or what would that be? Can you elaborate on that really quickly, Mark?
Yeah, no, that's a great question. I prefer to have a bias to equities. I've had a strong bias to equities, Luciana. So my thinking is I have a mix of personally stocks from Canada, a few stocks from the US. So my bias is equities. But what I meant by conservative assumptions for my retirement income plan is I'm not looking at 7, 8, 9%, and definitely not 10% returns or anything higher for my long-term projections. I actually use 5%, even though I have a slight bias to equities, although I do keep cash and cash equivalents. And I actually use 3% for inflation. I think the Bank of Canada has targeted, again, good, bad, or indifferent for the last few years. We all know about inflation, but I think they've historically targeted about 2%. I think long term, like we're talking decades, it's probably been around 2.5 or 3% long term inflation. So that's what I mean by conservative assumptions. I'm thrilled if I get 8% or 20% this year, but I'm actually not counting that on that year over year or year. So I hope that answers the question, but it's an excellent question.
Oh, that's great. Well, thanks for sending that in. All right, so we got a quick time for trivia. We've got some more fun stuff. We'll shift gears a little bit, Mark, and we'll go into a fun trivia that we're going to actually engage the audience to see if they want to try and answer this question. So we're going to put this up on the screen. We have a question for you on how much did the average Canadian couple over age 65 spend in retirement? So you can see the options that we are going to have available there. Is it about 48,000? Is it about 62,000? Is it 70,000, or is it 56,000? So a little bit of a range there. Just as we're waiting for our audience to answer that question or give their opinions, what's your opinion, Mark? So do you want to care to venture a guess? And nobody out there, nobody cheating and stealing Mark's guess.
Yeah, really. So put the phones down, I guess, folks, or Google away. But I would probably lean on B. I think A is a little bit too low because we're talking about a household couple, right? So I think A is probably on the lower side. I would definitely see C probably on the higher side. But if I had to guess, it would be B, just based on maybe the last couple of years of when the survey was done. So I'll stick with that.
All right. No, I think that's pretty good logic. And I don't know if we're ready. We'll see if we're ready here to give the answer. We'll put that up on the screen here in a second, and we'll let the audience know. I want to see what the audience's answers are. Sorry, we'll see what that is first, and I'll give the right answer. But yeah, pretty big breakdown. Not surprising that there's quite a myriad of responses here. It looks like the highest we have is tied actually the one that you said, Mark, which 62,000 and 70,000 from the audience's guesses. And I know, you know, from those game shows, usually the audience is pretty smart and they get the right answer if you ask the audience for sure. But they were, in fact, the right answer is 62,000. So according to Statistics Canada, which is a 2021 survey, that's the most recent, the latest year, this includes spending on food, shelter, transportation, healthcare, recreation, and income taxes. So great job. A lot of people in the audience got it. And great, you got it right too, Mark. So perfect.
Cool.
Hopefully nobody's super surprised by that. All right. Okay, so let's jump back into our conversation. So the second key step in the retirement planning process that you mentioned earlier is to determine the income streams that will support your spending goals. What would you say are the major sources of the income for retirees?
Yeah, so I think great question, or you know, kind of step in the planning process. But you know, working backwards, I would definitely say OAS. It's based on residency, so old age security, that would be one. You know, guaranteed income supplement is obviously tied into that based on income level. Canada pension plan, again, it's a contributory plan, so depending on how much you put into it. Then you have tax sheltered accounts, so think about RRSPs, tax-free savings account, so on and so forth. And then other income, right? So you could have the non-registered income. We have a little bit ourselves. We don't have rental income. But again, part-time work, it could be the hobby income, passion projects, or wherever you decide to do. So I would definitely think about those income buckets. And that's really aligned to what I mentioned earlier in terms of those key income sources to think about to meet that desired spend, which is really the number one priority to think about, is how much do you want to spend and potentially when do you want to spend it.
Okay, yeah, excellent. Great insights there. So that brings us to our third key decision of safeguarding a retirement plan, which is to maximize your TFSAs and RSPs ahead of retirement, if possible. Why might you say that that's a savvy decision for retirement for retirees down the line?
Yeah, so I'm a huge fan of the TFSA. I've been on record probably to say that it should be, you know, relabeled as something like a tax-free retirement account, because I think savings gives it the wrong name. But you know, it's certainly suited for short-term goals. You can save for, you know, dream vacations, weddings, cars, and what have you, and that's all fine and good. I've preferred to use it as a long-term, you know, tax-free retirement account. So I've been saving in more growth-oriented stocks myself, or low-cost ETFs that deliver growth, certainly more so in the last 5 to 10 years. You can draw the money tax-free. There's no tax consequences because you've paid money up front to put the money in the TFSA with your after-tax dollars. So awesome way to grow and have money compound. I think the contribution room just came out for 2025. I think it's retained at $7,000 a year. It'll keep going up with inflation. So we may see a bump in the next couple of years. And ultimately, I think, you know, getting back to your question, you know, keeping the TFSA alive and well and compounding, you have the potential to potentially draw down other accounts first. So tap into the RSPs that are tax deferred, but you will get taxed on that income eventually. And so I really think that the TFSA is kind of this, you know, all-in-one kind of great account. You can use it for short-term or long-term needs. RSPs for me tend to be the account I will focus on drawing down a little bit earlier. I've deferred tax for a while. So I've obviously put some of my hard-earned savings into the RSP. The money's been growing, thankfully tax deferred, but I will have to take the money out at some point through to feed my lifestyle, or through the retirement income fund when I turn in my RSP to a RIF. So all that to say, I probably will be tapping my RSP fairly early in retirement, getting the income stream coming from that to feed our lifestyle. But certainly an excellent account, and by no means should Canadians avoid contributing to their RSP. It's a great savings vehicle for retirement, but I have a huge bias to the TFSA, and I think it makes sense for any age, any adult to be contributing to the TFSA.
Well, those are some great points, Mark. And we do some classes on these types of accounts and things like that. And I always say the TFSA, in my opinion, is like the greatest gift that the government's ever given us, especially related to investing. Would you agree?
Yeah, absolutely. I think we're going to see the power of this more and more in the coming years as potentially contribution room keeps inching up. I've been fortunate, to, again, get lots of emails, comments on my site. I just had an article on my site about what's in your TFSA. So if folks want to take a quick search of that, and you can see the power of what some people have been able to grow in terms of investing in, mostly equities, and forgetting the savings name and really focused on retirement. Some of them have, well into hundreds of thousands of dollars in their TFSA. So kudos to them. They've saved, they've invested, they've done very well. And I think most Canadians should definitely look at this as a longer term savings and retirement income vehicle. But by no means is it the only thing that you have to use it for. So yeah, echo that. Yeah. Kudos to the TFSA and keep using it as much as you can.
Yeah, there are scenarios, where the RSP is great as well. And it's everybody's situation is different. But yeah, definitely something that's a great tool for sure. So that brings us right now, that brings us on to our fourth key decision to safeguarding a retirement plan, which is to try to withdraw each source of income in a way that can help lower your tax bill. So, and you have a fantastic chart that breaks this down for your retirement plan. Can you walk us through that?
Yeah, perfect. Yeah, I was hoping you folks would put up the visual there. So what's interesting, I think, for viewership today, and again, mentioned this many times on my site, and I've gotten many great comments from readers and other retirees or semi-retirees, is it's really hard to think about retirement in this, nebulous 30 to 40 year time frame. Like that's a big chunk of time, right? We don't even know what, is going to necessarily happen with inflation or rates of return or taxation changes in a year. So thinking about kind of your income buckets into 5-year intervals, I think really helps kind of frame things a little bit easier. The old adage, hear this in the workplace sometimes, and with big problems to solve, is how do you eat an elephant? Well, one bite at a time. So breaking your retirement income plan into some bite-sized chunks is probably a good way to look at it. So ultimately, I'm in that kind of first quadrant at the top left there. So full-time work / part-time work, and I hope I keep working, especially with my current employer in some capacity in the coming little bit, just because, like I mentioned, I enjoy it and I believe in the value proposition. But ultimately, this is all about a transition, and we've been working at this for the better part of 20 some years. So, I got it kind of shaded in yellow. Who knows what ages 55 to 59 might be, and we may not even need to work or want to work at that time. Work in the near term, non-registered income should be flowing in, live off some dividends from our various accounts for the coming decades. TFSAs, like I mentioned, I'm going to let those things compound away. That's tax-free income I can use later on in life if and when I need it. RSPs will start drawing down. Maybe the whole thing is gone by my 70s. Who knows, right? So I'm going to monitor all these things in these five-year increments. My wife is fortunate to have a pension from her work. So again, we'll make some withdrawals when the age comes. Same with my DB plan, my defined benefit pension plan. And then later on in life, old age security should kick in for both of us in CPP. And then there's a cash wedge or buffer that, gosh forbid, stock market calamity ensues. I don't want to withdraw anything. I got a big capital expense in the condo, whatever, I can pull that out if and when needed. So all that said, lots of different income streams and lots of variability in income streams. And again, maybe the visual will help the viewership today really thinking about their plan into some bite-sized chunks too.
Is that available on your site or on your blog at all, Mark?
Yeah, it is, of course. Yeah, I should probably turn this into a free toolkit for somebody as well. But yeah, it's absolutely embedded in a few posts, and I'm happy to share it with any reader that wants to ping me after the webinar. Just reach out and hit me up.
Absolutely. Well, one thing I noticed about your retirement income roadmap is that you have your lowest spending in your 50s and 60s, which are typically, you hear that term, the go-go years of retirement. Why not spend a little bit more aggressively during that period when you might be able to enjoy it?
Yeah, that's a great question. So our thinking is we probably will ramp up spending in our early years, but again, getting back to being a little bit conservative out of the gate, I don't mind doing that just because I don't know what's immediately around the corner. Through sequence of returns risks, people may hear that term a little bit in personal finance spheres and such. The risk zone for a lot of retirees or semi-retirees is really in the first 5 years, right? That's when the market goes down quite a bit. And we have some sort of episode like the Great Financial Crisis where things just bottomed out by like 20 or 30% in a matter of months. So I want to be able to safeguard our plan a little bit by doing some of the things I've talked about today, keeping a bit of cash, being conservative with my long-term assumptions and so on. But ultimately with this chart on the screen, which we've used with some financial tools, you can see my spending slowly ramping up, and that's largely because of the inflation factors that I've put in. So I've actually put in 3% inflation. That'll allow us to start our spending, I think, in and around maybe around the $75,000 mark a year, and that'll just keep going up and up to match inflation. So this is real chart, real potential for us. But again, I think it's important for all DIY investors or asset accumulators to be really variable with their income plan, and hopefully, some of these visuals and the 5-year charts help. But Brian, next year when I come back and we talk about how this is actually working in real time, I can let you know how the go-go years are going. So stay tuned.
Sounds like a plan. All right, I'd love to hear it. All right, so now, but what I want to hear right now, Mark, is we're on to the 5th key decision. So your 5th key decision to safeguarding a retirement plan is to consider delaying CPP and OAS payments as late as possible. Now, there's no right or definitive answer on when to take CPP and OAS per se, but how might delaying them help retirees down the line?
Yeah, so I don't think there's any one right answer per se, right? We talked about at the beginning, it depends for a lot of folks. But for me personally, and you saw it from my box kind of quadrant chart in the previous slide there, I think it makes sense for us to defer CPP and OAS for these 2 key reasons. One is I can actually withdraw some of the personal assets like our RRSPs and live off some of the potential dividends that we plan to in the early retirement years. So that allows us to potentially smooth out taxation over our 50s or 60s. The second reason why I want to defer that is I see CPP and OAS like big bonds, right? This is government benefits programs that are inflation protected. So they go up by the CPI, the Consumer Price Index, every year. And so, the ability for us to spend from our personal portfolio, draw that down, smooth out taxes over time before those income streams kick in, plus the fact that CPP and OAS are government benefits that are inflation protected. Those are big income protected bonds that are sitting there in older age. And to be honest, as my own advisor, as much as I'm passionate about this stuff, I may not be fully as immersed doing tons of webinars in my 70s and 80s. Maybe I will. Happy to do that. But ultimately, if I can get fixed income that's inflation protected at its highest value in my 70s, I don't have to worry about a lot of other stuff in my personal portfolio. So just some concepts for people to think about. I think we have on the screen here, there are some break-even ages in terms of when you start taking CPP in particular. And again, I think if you start early, your break-even age is probably in your early 70s. If you start taking at a traditional retirement age 65, again, your break-even age is a little bit closer to age 80. And then certainly if you take it at age 70 CPP, you're getting a 42% income boost by delaying it over age 65. And now your break-even age is around 82. So you'd want to be living to 82, 83 to break even. So again, who knows what the future holds, but I would say when in doubt, and if you don't need the income in your early retirement years, it's probably best to defer that money for longevity risks.
Oh, perfect. Yeah, thanks for that insight, Mark. I appreciate that. But I want to move on to, we've got a really interesting section that we want to add in. We want to get your opinion because you've offered some really great information and some really great answers to these questions. But we've got a few clips from previous webinars, so other guests we've had. So on retirement specifically. So we'd like to bounce some of those ideas off of you to see if you agree or disagree and why. So what we're going to do is we're going to run these short clips. They're only about a little bit over a minute each. The first one, our first idea comes from financial planner Thomas Chan. He says it can make more sense for some retirees to prioritize investing in a TFSA over an RRSP when saving for retirement.
Even if you do the contribution in your tax-free savings, do not give you the tax benefit right now. But after 20, 30, 40 years of growth, then when you take it out, it's not going to be taxable. So literally, you can have a $1 million in your tax-free saving, and you can still consider yourself as a low-income family, and you don't get any clawback, and you might be able to get GIS.
All right, well, what do you think about that, Mark, and the idea of focusing on the TFSA over the RRSP?
Yeah, I echo what Thomas was mentioning. Now, certainly I wouldn't have any Canadian investor saving for the retirement to aspire to have GIS. So I want to make that disclaimer, is that we don't want to necessarily aspire to get guaranteed income supplement and such. But ultimately, I do agree with the premise of focusing on the TFSA for any income earner. So if you're a lower income earner today, that's more than fine and totally okay, where you can try to contribute to your TFSA for any after-tax savings. So like Thomas said, that money can grow, like I mentioned, and it can compound decades into the future. There's not a lot of value in necessarily contributing to your RRSP when you're in a lower income or even a modest income in today. And the reason being for that is while that's a great vehicle to save for retirement, your tax rate when you make the contribution could probably be the same as when you make the withdrawal. So it's a bit of a tax neutral. Ultimately, where the RRSP really benefits folks is if their income is higher when they contribute and their income is lower when they pull the money out. So you're doing a little bit of tax arbitrage, if you will. That's where the benefit of the RRSP comes in. Because you contribute to the TFSA with after-tax dollars, you've already paid income tax, you've already gotten your paycheck or what have you, then anything that compounds in the TFSA is tax-free, grows tax-free, and you can take it out tax-free. So echo it, use the TFSA, not necessarily for savings, but for retirement income plan, I think, as much as possible.
All right. So we have one more. Hopefully we can get to this one here. So our next video comes from DIY investor Henry Ma. I know he's a favorite of yours. And he says he earned so much dividend income that he's confident he'll never run out of money in retirement.
I don't have a company pension. I only have Canada Pension and Old Age Security. But once we received more investment income than we needed, and it continued to grow, it got to the point where, you know, markets up and down, recessions, a possible economic concerns, rising interest rates, they aren't a factor, at least not in our retirement.
What's your thoughts on that, Mark?
Yeah, I mean, Henry and I have known each other for quite a few years. I was happy to read, and I think I actually provided a forward to one or two of his books actually in the past. So I certainly like Henry's approach overall in terms of the income investing and the dividend investing. That being said, you know, just focusing on the dividends, I have to articulate to all the viewers, including what I share in my own advisor as well, is that dividends, while very good, very juicy, and provide real tangible income, they're just one part of total return, right? So dividends plus price appreciation equals total return. So in theory, but also in reality, dividends, while providing tangible income, a lot of dividends you're actually giving up on the stocks or whatever you buy, you're giving up the growth component. And you'll see that if you look at some of the stocks that provide a high dividends or what have you. So while I totally agree with the premise that you can have a fairly sizable portfolio, that sizable portfolio of stocks pays out dividends, and that dividends provides the income for your lifestyle, because that is a part of our equation. I would also argue and say that just focusing on dividends is actually missing part of the growth story as well. And if you've been, again, watching the stock market, like we've talked about earlier in this episode, the TSX, give or take, it's up 20%. There's not, not every dividend paying company is up 20% this year. Why? Because they're paying out some of their returns to shareholders. So you're giving up a little bit of growth for the income today. So it's a bit of a trade-off. But ultimately, if dividend investing works for you as a 100% foolproof kind of plan that you've designed, and it meets your income needs, ultimately meeting your needs is all that matters at the end of the day.
Oh, makes sense. And just a quick reminder to the audience too, if you're looking to find more information on those clips, or if you want to watch those further, they are available in the resources section of the broadcast console. So just on the top left there. So make sure you grab those links before you go, and you can watch those further on, or you can check them out in Webbroker as well. You can find them in our Learning Center and on TD's YouTube page. All right, Mark, so we're going to have to leave the interview portion of our conversation there, but we're not done yet. So we've got you here to, we're going to open the floor to take questions from our viewers. Are you ready to hear what our viewers want to know more about, Mark?
Yeah, surprise me. Can't wait.
All right, okay, let's go. Let's check it out. So I'm just going to pull up some questions here. So these are live questions coming in from our audience. And I've got a question from, it looks like Jonathan, that I think is one that we want to give to you first. So we'll put that up on the screen. It's a little bit of a long one, but I'll try and read it out for you too, Mark. So people talk about using dividends to cover monthly expenses, but what do you do when most of your money is tied up in RSPs and the dividends keep growing the RSP? So how can this money be accessed tax efficiently, or should a different investment strategy be incorporated? That's a great question.
It is a great question. It's very nuanced, and I think there's a lot of pieces to it. So I'll kind of break it down maybe in the order that that Jonathan kind of presented here. So let's start the first kind of piece, which is what do you do when most of your money is tied up in RSPs? So this is a good problem to have, first of all, if you have a lot of money in your RSPs, because it means things, you know, you've saved and invested well and money's grown. So the second part of that equation is when dividends keep growing in the RSP. So tactics that I've seen for some investors, fairly simply, whether you invest in mostly stocks that pay dividends or maybe some ETFs that pay distributions, is when they get close to retirement, they actually turn off the dividend reinvestment plans. So the ability to reinvest dividends and buy more shares of stocks or ETFs, they actually turn off the taps there, if you will, in the RSPs. They let the dividends and distributions come in cash, and then they withdraw that money. So hopefully I'm answering that part of that question accurately for you about what to do. But the second part is really interesting. How can this money be accessed tax efficiently? Well, the reality is RSP money, when it comes out, it doesn't matter if it's all dividends, it doesn't matter if it's all capital gains, it doesn't matter if it's interest, it's taxed. So it kind of is a bit of a wash. It really doesn't matter. So then what you need to be thinking about is, like I mentioned earlier in our webinar today, how much of the RSP income should you be taking out amongst other income sources? And so what you'll need to think about is the proportion of RSP money, however it was made, how that comes out and how that gets lumped in with part-time income, CPP, OAS, or other types of things. So those are the things I would be thinking about. Is having RSPs tied up with a lot of money is a good thing. Keeping dividends growing to a point is also a good thing. But at some point, you need the money coming out, and it doesn't matter how it was made. It's going to get taxed on when it comes out.
And that's where I think some of those calculators can be useful too. Would you agree, Mark, where you can put in some of those scenarios, maybe retire a little bit early or shift your RSP withdrawals to the earlier stages where you maybe don't have as much income and things like that. You can back test those ideas.
That's exactly it, Brian. So you were reading my mind. So I hope that helps Jonathan out and some other viewers as well.
All right, excellent. That's a great question. And so we have a question from Bernard. So we'll put that one up on the screen. So dividends versus capital gain. Dividends with the gross up cause more issues trying to stay under OAS clawback levels. So your comments on structuring income based on capital gains versus dividends.
Yeah, so this is certainly an issue for potentially higher income earners and or earners that may have been investing in their taxable accounts, their non-registered accounts for many years. So Bernard is quite right in that when you invest in stocks, ETFs, equities, what have you, and those dividends are flowing in a taxable account, they are taxed. And so the question becomes, where's the threshold in terms of how much dividends or income is coming into your taxable account that you're taking a tax hit on, and other income sources that may push you up into an OAS clawback level. So just a quick primer for folks. OAS clawback, I'd have to get the numbers, but we're looking at about $85,000 to $95,000 per person, where old age security starts to get slowly clawed back, because basically the government is saying you may be old age, but you're not income insecure, right? You have income security, so you don't need old age security. So where this is important is you'll want to work with fee-only planners, projections folks, what have you, whereby you can understand the sum of your dividends that are contributing, pushing you close to the OAS clawback. So most people do not want to give the OAS money back in terms of clawback. So it's important for you to, as you get older and your wealth accumulates in taxable accounts, potentially have a bias to capital gains. Capital gains, on the flip side of dividends, only are incurred, or you can only incurred when you exercise those gains. So you make a sell on a stock, things have grown, you make a sell on an ETF, it's grown a lot in value, you may have 50% of those gains to be taxed in a given year. So capital gains can be a little bit more strategic in a non-registered account than dividends. Dividends are going to keep flowing in potentially, and you're taxed on them all the time. Capital gains, you can be a little bit more strategic. So for those people that are investing in taxable accounts, this is a great question and something that you'll want to do some projections or some financial income planning around, because at some point, dividends are great, just like Henry kind of alluded to in his clip. Dividend income is great, but if it's coming at taxable income and you've got to make RRSP withdrawals and you're getting OAS and CPP, some of that OAS income could disappear from you.
Well, you just brought up something that I thought of, Mark, is oftentimes in the conversation, people are focused on TFSA and RSP, and they'll often ask us that question, well, what do I do once I max those out? Like, I think we forget as well, like, you can go into equities and stocks and a lot of things that will have a capital gain, but will only be taxed when you sell that position, right? So it's kind of almost its own little secret TFSA in a way, tax-free while it's growing. Like, what's your thoughts on that?
Yeah, absolutely. I mean, we've been fortunate where, again, we've been maxing out our TFSAs. Like I mentioned, I love the account. We talked about that. I have a small workplace pension. I also contributed to my RSPs because I knew there may come a time where I may want to retire early or do some sort of semi-retirement down the road. And lo and behold, here are the days. But we were also fortunate to invest in our taxable account after TFSAs and RSPs were done for. So over time, I've certainly come to appreciate myself that capital gains can be a very efficient way of investing, and can be a huge way of kind of deferring tax, if you will, until they're incurred. So I would encourage folks that have TFSAs maxed out, RSPs maxed out, and have you, if they are investing in a taxable account, dividends are great. Dividend income is great, don't get me wrong, but it may not be the most efficient way to invest in those taxable accounts. Capital gains could be much more efficient depending on all your income sources.
Okay, great. Well, we've got a really good question from Maureen that's kind of along this same topic, saying, is there any advantages to drawing down RSP versus TFSA or unregistered savings first? So definitely on topic here. So I have index CPP and defined benefit to rely on indefinitely for a good base income. But any thoughts on Maureen's question there, Mark?
Yeah, so quick thoughts, Maureen. Kudos for having the index CPP, so Canada Pension Plan, and then obviously the defined benefit as well, because those are kind of, like we've mentioned, bond-like structures, right, where you're going to get paid basically like a paycheck, in perpetuity. The advantages of drawing down the RSP first is, I think, again, to basically get some of that income flowing, which is from that tax liability, in my opinion. So RSPs or RIFs are basically a tax liability that's sitting there. And depending on how much you have, getting that income flowing sooner than later can, again, I think I mentioned this earlier, help you smooth out taxes. You may be interested to know that most financial planning professional software typically has a default of non-registered, registered, which is RSPs, non-registered, and then TFSAs. That's typically how they're structured. So you have RSP income coming out, you have non-registered coming out depending on how much, and TFSAs. The second bias to a lot of professional planning software and any modeling that planners or other folks that provide services do is flipping the order a little bit. It's non-registered savings if you have a lot, then RSPs, and then TFSAs at the end. So something to think about, that if these software programs are designing the TFSAs, air quote, until the end, allowing you to have tax-free assets to compound away for many decades, then your equation just becomes how much of the RSP comes out sooner than later, or how much of the non-registered comes out sooner than later. So it becomes an easier problem to solve. But I hope that really helps you out in terms of wrestling, instead of 3 accounts at the same time, leaving the TFSAs later on in life for that tax-free compounded income, and just focusing on the front end, the RSP or the non-registered. And sometimes a blend of both may be beneficial to you. Great question.
That was a great question from Maureen and from everybody so far. I'm really, really impressed with all the questions. That being said, we're getting close to time, Mark, but are you okay with sticking around for a little bit longer?
Yeah, a couple more questions is great. Happy to take these on.
Okay, we've got a lot of great ones. I don't know if we'll get through them all, but we want to get through as many as we can. I've got a question from, it looks like from Dominic, saying, being new to dividend investing, how can you time the market when buying stocks? So example, bank stocks, when you're depending on fixed income from these stocks. That might be an age-old question here.
Yeah, so time in the market is your friend, not necessarily market timing. And I've have a few personal stories on my site to prove that. But I generally, and I can only speak for my personal biases and prefaces, Dominic, is I tend to invest the money when I have it, and I try to look at the, my asset mix or the mix of companies that I have, and try not to over rotate in any one sector. So like bank stocks, for example, I don't go all in on that, just like I don't go all in on tech. The other consideration for you, again, time in the market versus market timing, and try to figure out the best price ultimately. Sure, you can look for 52-week lows, you can look for higher yields at a point in time. But ultimately, those types of decisions are really up to you. I've generally learned that when I have the money to do so, my when in doubt pick is I invest in low-cost ETFs. But I also look at my asset mix or my stock mix so that I don't over-rotate into financial sector, tech sector, consumer staple sector. So new to dividend investing, definitely takes some time. I wouldn't over-obsess about market timing. Time the market is ultimately your long-term friend.
All right, excellent answer. Great question. We have another one from, looks like from Nashelle, saying, what are your thoughts about annuities indexed to inflation?
Yeah, I don't mind annuities. I mean, I don't have any plans, Nashelle, to invest in annuities, but annuities kind of in a more simpler form are really just creating your own pension for those that don't have it. So for annuities that are indexed to inflation, that could work very well for you. You'd have to look at kind of other factors in the fine print in terms of how those annuities are structured, joint annuities or what have you. But the whole concept of creating your own pension is not new, and I think it's a valuable one in general. But yeah, I would definitely have to know a little bit more about where your situation at is, where you're coming from. But annuities can make sense, is what I'm saying, for some Canadians for sure.
Just to help our audience too, because I always think of this, my wife knows nothing about a lot of this stuff, and if I said to her an annuity, her eyes would glaze over and she'd have no idea what I was talking about. Can you, for our audience, just explain really quick, what is an annuity?
Yeah, so annuity is basically, just think about it as kind of income for life per se. You're giving up some of your assets, handing those over to a life insurance company or similar kind of financial entity, and what you're doing is you're getting a guaranteed payout for the money that you're giving them. So you're basically creating your own pension, not unlike what you do, I guess, over a workplace period with a defined benefit contribution. You're giving up little sums of your money over many decades, and you're getting a defined benefit. Annuities are kind of at the very back end. You've got a lump sum money, you're giving it to a company, and they're promising to pay you kind of a defined benefit per se out of that lump sum. So annuities will be, the payout will be different for you depending on various factors: joint, single, indexed to inflation, not. So there's lots of variation in the annuity product space. It'll also depend on your age, because it's based on, like any pension, mortality credits and how long you live and how long the population of the people that pay into the pension or the annuity live. So lots of complex things to talk about, and probably a topic for another day. But creating your own pension through an annuity is not something that I would totally dismiss whatsoever, depending on other income sources that you need.
Okay. Well, it's a good option for us to know about for sure. So we have Rick. We're going to let Rick get away. He's getting a 2-for-1 here. He's got 2 questions.
Okay,
so
Rick.
He says 2 questions. Why is real estate not part of your portfolio? So many Canadians swear by real estate. And then 2, thoughts on contributing to an RRSP, a better choice than investing within a corporation?
Okay, so good for you, Rick, on the 2-for-1. So I'll tackle the first part. I actually have a real estate in our portfolio, but it's actually where we live, so our condo or our home. So I do consider our condo or our home, that's debt-free, part of our portfolio. But to your point, it's not part of my investment portfolio. I actually used to have real estate investment trusts and some other companies in my portfolio. I've largely decided that I want to simplify my stock portfolio and my ETF portfolio over time. Excuse me. So yeah, real estate is actually part of our total portfolio, our total net worth. But I don't actively pursue REITs, or I'm not a landlord anymore and what have you. Second part of that one, thoughts on RSP, better choice in investing in a corporation. It depends. I think if you're talking about being incorporated, lots of ways to invest inside your corporation or holdco. But I would say, generally speaking, for most Canadians, if they can contribute to their RSP, max that out. If they can contribute to their TFSA and max that out. And if you have a corporation on the side where you have cash flow for your business or you want to invest in that, then more power to you as well. But it really depends on your personal situation, whether or not you're contributing to your RSP or you're an incorporated individual and you're leaving money in the holdco, because there's also a tax liability in keeping assets long-term inside your corporation. Hope that helps, Rick.
All right. Oh, great job answering those. And so we have a question from Mike. Mike is asking, saying, since RIF income is not considered eligible for pension credit or eligible for pension splitting before the age of 65, are there any advantages to converting your RSP to a RIF before age 65?
Yeah, so Mike is correct in that the RIF income is eligible for pension splitting. It's eligible for pension tax credits at age 65. I would also say that the advantages to his question about converting the RSP to a RIF at 62, 63 as an example, is if you really want the predictable income. So some folks, not unlike a paycheck from work, they rely on a predictability where they want certain levels of income coming from their accounts. And for budgeting purposes, like we talked about earlier, knowing where your income sources are and the tax burden of what's coming out can help people plan and budget. I've personally found, and I've talked to many DIY investors, semi-retirees and retirees over the years, they see advantages of keeping their RSP largely intact and being a little bit strategic with their RSP withdrawals because they have other income sources at play. But it really depends on the person, and I think it really depends on your income needs and the totality of your income sources to make that decision. So great question, Mike, and I hope that helps a bit.
Yeah, another good one. Great answer. So we have a question from a little bit shorter one from Isabel. This is a short one, but a good one, in my opinion. So is having a retirement portfolio all in dividend securities after 70 years old too risky?
Again, depending on where Isabel is coming from in terms of all her income sources. So let's maybe walk down a quick example. Say Isabel has a bit of CPP income, steady inflation protected income like we talked about, old age security, same, and potentially some TFSA savings, which are maybe growing, and they're basically a larger emergency fund. Depending on Isabel's income needs and the collection of dividend and income securities that she has, maybe it's not too risky at all because all her income needs are met with CPP and OAS and future capital expenditures maybe from the TFSA. That said, maybe there's not a lot of CPP income or OAS income, and there isn't the TFSA there. So going all in on all types of certain types of assets, potentially, I should say, is too risky depending on your income needs. So it all starts with understanding your income needs and then figuring out, I think, your income sources for those needs. I do know quickly, there are many retirees that chime into my site. Canadians have a huge affinity to dividend paying stocks, we know in general. But having a diverse collection of stocks and being diversified is going to help, air quote, dialing down that too risky state. So I hope that helps Isabel a little bit, but ultimately it depends on a lot of other factors.
Well, one thing to add to that too, Mark, is, one of the things we haven't talked about yet today is just that estate aspect as well, right? With the RSP being something that's kind of risky from an estate perspective, if you're thinking of leaving that to your heirs, there's a major tax implication, right? And then that could be considerations with your TFSA and your taxable and so on. So there's all kinds of risks to consider. Would you agree with that? Yeah,
absolutely. So, having, statements like, all in for certain securities, makes me question from the particular viewer here, well, what does that mean in terms of context of everything else? How much is in the RSP? How much is in the TFSA, if anything? And where do those liabilities exist amongst all the assets that Isabel may have? So it leads me to think a bit more questions, but ultimately, if the stable income that you're getting from all income sources is meeting your needs, then it's probably not too risky. But again, it depends.
Yeah, and absolutely. It comes down to every individual's suitability and, what risk would be for their situation. So that's a good point. All right, so we're going to finish off with one other question, but it actually is one that two different people asked. So it was a question that Stephanie and John both sent to us saying, with a cash wedge, so keeping dollars in high interest savings account, why not in TFSA?
Yeah, so that's a great question. So I think for me, the cash wedge that I refer to, it's really not just in one account. It's really a little bit of cash in all accounts. So maybe I can explain that a little bit. And that I do keep a bit of cash buffer in my RRSP because that's for future withdrawals. So that's me personally. That may or may not apply. Other people may just sell equities and do that. But for me, I always like to have a bit of cash in the RRSP for our future withdrawals. Keeping the cash only in a high interest savings account, you're taxed on that, of course, depending on the rate you're getting, 3 or 4% points these days. The benefit of that, it's quite liquid, right? I think of RRSP assets as a bit tied up personally, right? There's a tax consequence there, right? Or a deferred one. Keeping some cash in a high interest savings account, it's liquid, it's ready when you need it. You can pull it out for emergencies, whatever it may be. Keeping the cash in the TFSA, while very good, again, it kind of conflicts with my personal long-term intentions of having that TFSA really compound. So keeping a lot of cash in the TFSA is actually a drag on my long-term equity compounding returns. I'm not saying that keeping some cash in the TFSA isn't smart, but that's if you need to use the cash or you need to liquidate things. But I've tended to structure my accounts a little bit differently, and it all depends on your short-term goals and your long-term goals. And I tend to keep my TFSA as a long-term seeking vehicle, a little bit of cash and savings as a short-term need, and then the cash wedge for the RSP in particular for money I need in the next couple of years. So I hope that helps answer the question, but these are all great, really thoughtful comments for sure.
And I think the TFSA, there was, like you said, the name earlier, you mentioned that the tax-free savings account. I think that was a disservice in a way because a lot of people were putting money just in cash, right? Like they're not taking that advantage. They're never going to get taxed because they're not really getting any return. Is that why you were saying maybe that savings name is not great?
It's not great, but I think Canadians have really caught on to the power of this account, and now that we're into almost 15 years-ish of the TFSA being in its inception, for some people that kind of looked at the TFSA out of the gate as a true tax-free retirement income or growth vehicle. Again, the evidence is on my personal site, but I know other retirees or semi-retirees are there. Some folks have been very good to max it out, and they literally, instead of having 100,000 of cash contribution room, they're well over 200,000, or some of them over 300,000 of compounding power in there. So that is not an insignificant amount of money, and because it's all tax-free, it's probably even more powerful. So yeah, definitely think about the tax-free retirement account, not so much the tax-free savings account. But again, everybody has different short-term and long-term goals.
Since we're getting close to the holidays, I can say that's the gift that keeps on giving.
Absolutely, Brian. Well played.
Absolutely. All right, Mark. Well, thanks so much. I really appreciate you sticking around a little bit longer to answer a few of those questions. It's always a delight to meet with you. We've done it a few times so far. Your answers are amazing. I think our audience really enjoyed. Just a reminder to everyone, though, that we will be able to watch this. You can watch this on an archive basis, too, if you want to kind of pause and rewind and take a look. And also check out our upcoming webinars. So we'll put that up on the screen again, just a reminder. In the console, you should be able to see those. We've got a lot of great upcoming webinars. And then also there's the resources on the left-hand side. So if you want to check out Mark's website and some of those other calculators we have, there's all kinds of great resources available. And lastly, there is a survey. So we want to know what you thought of this session. Did you like it? Did you love it? Do you have any feedback? Do you have any other topics you wanted us to look at? Maybe we'll have Mark. I'm sure you'd probably be all right with coming back again, right, Mark, if we have another retirement topic?
Yeah, for sure. Happy to do so.
Absolutely. So let us know. Let us know in that survey how we did today. We'd love to hear your feedback. And any final thoughts, Mark?
No, just hope folks have enjoyed the session. Obviously, retirement income planning is a huge body of knowledge. But I think over time through these types of webinars and other events, it seems like Canadians are really doing well overall, I would say, with figuring out how to save, even though it's a challenge on sometimes. But there's a huge body of knowledge in terms of the retirement income puzzle, and we could talk more about it. And I can give you real-time updates in terms of future events, in terms of how things are going with us. And I'll keep everybody posted on my own advisor as well. So check it out. Happy to reply to every comment, read every email that I get, and put out new content every month. So thanks again.
Sounds good. Yeah, we're going to want to see some pictures of you on the beach for your early retirement.
I will do that, Brian.
Sounds good. All right. Thanks so much, Mark. Thanks, everyone.
Have more questions? Check out the links to the right and in the description below.